Imagine this, a company operating in this huge global education market. We're talking potentially $433 billion by 2030.
Yeah, massive growth projected.
And this company, it's showing impressive revenue growth, looks like they've slashed their net loss. Great, right? Textbook success.
On the surface, absolutely.
What if that same company is actually, well, teetering on the edge of insolvency?
Yeah.
Selling off its core assets just to pay the bills.
And facing a very real threat of getting kicked off a major stock exchange.
Precisely. Today, we are diving deep into exactly that kind of story. Welcome to the Deep Dive. Today, we're plunging into the complex world of EpicQuest Education Group International Limited. The ticker is EEIQ.
Nasdaq EEIQ. It's a microcap based in the BVI but operating in the U.S. and Canada. Big ambition.
Big ambitions, yeah. We're going to look at their business model, those dual revenue streams, their global strategy, and critically, the serious financial headwinds they're up against. So our mission today is pretty clear. Equip you with a really thorough understanding of EIQ.
We'll unpack the business, take a hard look at the leadership, dissect the financials,
Gauge the market mood, check out who actually owns the stock, and weigh up all those risks. Big risks.
By the end, you should have a holistic view. It's fascinating, but financially fragile. That's the word.
Fragile, exactly. Yeah. Okay, so to guide us, we've split this into two parts. Part 1 covers chapters 1 to 3. That's the business, the management, and the financials.
That's core stuff.
Then in part 2, we'll hit chapters 4 through 7, market sentiment, ownership, risks, and our final outlook.
Sounds good. Let's get into it.
#tag chapter 1, the business of global education. An analysis of EpicQuest. All right, let's start with the basics. Understanding EpicQuest's business.
Yeah.
As you said, it's a British Virgin Islands holding company. Operations are mainly U.S. and Canada.
Right. So if you invest, you're buying into the holding company, not directly into the schools. That's important.
And they have this hybrid model, two main ways they make money. First is direct education services.
Tuition and fees, basically.
Exactly. From schools they own, like Davis University, Ohio. That one's been around forever, since 1858.
Wow, yeah.
And EduGlobal College in Vancouver, which focuses on English language programs, transfer pathways.
Okay, so owned institutions. What's the second stream?
That's recruitment and support services. Think commissions and fees from universities they partner with.
Like acting as an agent, but maybe more involved.
Yeah, much more. They highlight this long-term relationship with Miami University of Ohio, plus deals in the UK with University of the West of Scotland, Coventry University.
Got it. So they own some schools, and they partner with others, and they frame this as an end-to-end solution for international students.
They do. Can you elaborate on what that actually means in practice?
Sure. It's pretty comprehensive. Before students even apply, they help with language testing, like the ITEP counseling, applications, even visa stuff.
So, holding their hand from the start.
Pretty much. Then there's transition support, pre-departure briefings, sorting out accommodation, and once they arrive, airport pickup, dorm management, cafeterias, academic help, internships, even shuttle buses.
Wow, that's a lot.
It is. The idea is to reduce all that friction,
Yeah.
Make it easier for international students to navigate the whole process, less uncertainty.
So where does that leave them in the market, scale-wise?
Tiny. We're talking a market cap around, $9.96 million. Definitely microcap territory.
So they're not trying to be huge. It's more of a niche play.
Seems like it. Focusing on accessible pathways, maybe for students who wouldn't easily get into bigger universities directly. Their whole pitch is cost-effective, high-value-added academic experiences.
Helping students reach aspirational goals through practical education, career-focused stuff.
Right. Now, stepping back, this whole international education market is booming. You mentioned the projection $196 billion in 2019, potentially $433 billion by 2030, over 8 million students globally.
That's a huge tailwind.
Definitely. And the trends fit EEIQ's model, sort of. Demand for career-focused programs, global partnerships, maybe using tech like AI eventually.
But the competition must be fierce.
Oh, incredibly. It's super fragmented. You've got the big universities recruiting directly large education groups like Shorelight, Study Group, ENATO.
Right, the established players.
Plus, alternative countries offering degrees in English now. It's intense.
And then there's the regulatory side. Visas, immigration policies.
Hugely sensitive, yeah. We're seeing noise from Canada and the UK about maybe capping international student numbers.
Which could push more students towards the U.S.
Potentially. The U.S. takes a smaller percentage overall. But these policies shift fast. It's unpredictable, a constant risk.
What about barriers to entry? Is it easy to copy what EEIQ does?
Well, starting a simple recruitment agency, pretty easy. But EIQ's model, actually buying and running accredited colleges, building those long-term university partnerships, that's harder.
More substantial hurdles.
Yeah, though not impossible. Which brings us to their moat, their competitive advantage. Is there one?
Let's break it down. Brand strength,
Minimal, really. Niche channels. No pricing power to speak of.
cost advantages, economies of scale.
Nope. Too small. Their financials actually show a high-cost structure.
Okay. Network effects, switching costs for students.
There are some switching costs once a student is enrolled, sure, and the university partnerships create a modest network effect. But it's not, a powerful defining moat.
So what is unique?
The unique assets.
Yeah.
Owning Davis University and EduGlobal College, that gives them control over the product.
That sounds like an advantage.
It is, but here's the catch. It's a double-edged sword.
How so?
Because owning and operating colleges comes with massive fixed costs, faculty salaries, campus upkeep.
Right. Bills you have to pay no matter what.
Exactly. And that high-cost structure. It's a major reason they're so financially fragile. So the moat is actually expensive and risky.
Hashtag tag tag chapter 2. Management evaluation.
Okay, moving on.
Chapter 2. Management evaluation. A business is only as good as its people, right? Especially in a tough spot like this.
Absolutely critical. Who's running the show?
Key figures are Jambo Zhang. He's chairman and CEO, the founder. Been in international education since '96, founded the predecessor company in 2012. So long-term involvement.
Okay, deep industry experience.
Then there's Jinyu Wu, the CFO and a board member. He has a PhD in finance, professor, associate dean at University of Manitoba, strong academic and finance credentials.
Sounds like a solid team on paper, but how are they actually handling the crisis? Because there is a crisis.
Right, that Nasdaq notification. They failed to keep the share price above $1. Deadline is September 1, 2025.
And they had a similar issue before, right? Resolved it in January.
They did. But you could argue it's symptomatic of something deeper, this severe, worsening liquidity crisis.
Which raises the question. You've got leaders with great academic and operational backgrounds, but is that the ideal skill set for an urgent turnaround? Usually that demands sharp financial restructuring chops.
That's a fair point. And what about transparency? How are they communicating this situation?
Well, mostly through press releases, and those tend to focus on the positive, like the revenue growth.
Yeah, I noticed that.
There's a conspicuous lack of detail about the really worrying stuff. The liquidity crunch, the negative working capital.
So selective communication, not the full picture.
It feels like it. Highlighting the good news, downplaying the balance sheet and cash flow problems.
Okay, what about their capital allocation strategy? Where are they putting the money they do have?
Their stated strategy is growth organic expansion plus M&A. They bought Davis, EduGlobal, talked about sports education.
Sounds ambitious.
Almost. Disconnected from reality. They have, what, $0.33 million in cash? Any M&A needs massive new funding.
So current decisions are driven by survival, not strategy.
Pretty much. It's about keeping the lights on day to day, not strategic growth investment.
Yeah, and returning capital to shareholders.
It
And
is.
buybacks.
None.
Yeah.
Zero history of that. Instead, it's a history of shareholder dilution.
Like that $1.8 million offering in May.
Exactly. And there's a prospectus out for potentially selling another 800,000 shares. It signals a business that basically just eats up cash, doesn't generate it,
Which leads us to return on invested capital, ROIC.
and it's bad. Ably negative, minus 38.72%.
Ouch.
Yeah, that's a huge red flag. It means the money they've invested in the business just hasn't generated profitable returns. A fundamental failure to create economic value, really.
Hashtag tag check chapter 3. Financial analysis. All right, chapter 3. Financial analysis. Let's get into the numbers. This is non-negotiable for a deep dive.
Absolutely. Where do we start?
Market cap, as of August 23rd, 2025, around $9.96 million. Like you said, tiny. Highly speculative, likely very volatile.
Macro cap volatility, yeah.
Revenue growth trends, it's been choppy. That first half of fiscal 25 showed a strong 29.1% jump year over year.
Which sounds good in isolation.
But the 5-year compound annual growth, basically flat to negative. So volatile, unpredictable top line.
Okay, what about profit margins? Can they actually make money on those sales?
This is interesting. They have improved their gross margin recently. Hit 63.7% at H1 2025. It's pretty good.
Suggest maybe better cost control in the direct services or a better mix.
Could be. But That strong gross margin gets completely wiped out by high operating expenses.
Selling general administrative costs.
Exactly. So operating and net margins have been persistently deeply negative for years.
But didn't they report a much smaller net loss recently, like near break even?
They did a dramatic reduction to just negative $0.16 million in H1 2025. But you have to see that as one single data point against a long history of big losses. Is it sustainable? That's the question.
Right. A blip or a trend? Need more evidence.
What about generating actual cash? Free cash flow.
The moment of truth.
Yeah, consistently failed.
Yeah.
History of significant cash burn from operations. In the first half of 25, they burned through $2.29 million just running the business.
Wow. And over the last 5 years?
Only 1 year with positive cash from operations. One. It shows they just can't fund themselves without constantly raising more money.
Okay, let's talk stability. Or lack thereof. Earnings consistency.
None. Just a consistent history of net losses.
Debt to equity. Sometimes that gives a clue.
It looks manageable on paper, around 29.7%, but that's really misleading.
Why misleading?
Because their biggest financial pressure isn't formal debt. It's the negative working capital owing more short-term than they have coming in, plus that constant cash burn. That acts like high-interest debt draining them.
Okay, so the balance sheet ratios are key. What's the current ratio?
This is probably the most critical number right now. As of March 31st, 2025, it was 0.57.
0.57. Oof.
Yeah. For every dollar of bills coming due soon, they only had 57 cents in readily available assets. That screams liquidity crisis. Serious concerns about them being a going concern.
And dividends are obviously out of the question.
Completely. So that H1 2025 profitability, the reduced loss that made the stock jump over 100%.
It looks like an illusion based on this. Accrual accounting versus cash reality.
Exactly. Because while the net loss shrank, their actual cash plummeted, down 71.3% to that dangerously low $0.33 million. And the current ratio got worse.
So the headline looked good, but the underlying cash situation got even more critical.
Precisely. It's a cash flow crisis, plain and simple.
Yeah, so where did any cash infusion come from, if not operations?
Good question. The cash position was propped up, basically, by non-operational stuff. Specifically, $1.5 million positive cash flow from selling real estate.
Selling off property, their physical assets.
Yep, they're liquidating core physical assets to fund day-to-day operational losses.
That is not sustainable. That's a classic sign of deep financial distress. Selling the furniture to heat the house.
Okay, let's try to value this thing. Relative valuation. PE is meaningless with losses. Price to sales.
PS is about 1.06x, which is slightly below the peer average of 1.2x.
But does that tell us much?
Not really, because it completely ignores their inability to turn sales into profit or cash, and it ignores the huge balance sheet risk we just talked about.
What about intrinsic value, like a discounted cash flow model?
Look, doing a DCF for EIQ is, well, it's an exercise in speculation, Frank.
Since the cash flows are negative and all over the place.
Exactly. Highly unpredictable. But, okay, for argument's sake, let's build a highly optimistic model.
What kind of assumptions?
Aggressive revenue growth, say 20% for 2 years, then tapering down. A truly heroic assumption that they somehow reach a 5% positive free cash flow margin within 5 years.
Which they've never done before.
Never. And we'd need a really high discount rate, 20%, maybe even 25% to account for these extreme risks.
Okay, so with all those optimistic inputs, what's the number?
Even then, the resulting intrinsic value range is maybe $0.20 to 45 cents per share. That's with rose-tinted glasses on.
Hashtag chapter 4. Market sentiment. Okay, let's shift gears. Part 2, chapter 4. Market sentiment. How does the market actually feel about EAQ?
Well, first off, it's basically ignored by Wall Street. An orphan stock.
No analyst coverage to speak of.
Practically none. There was one price target from March 2024, $2.35, but that's completely stale now, totally disconnected from the current situation.
So the price is driven by?
Retail sentiment, mostly, and reactions to company news releases.
Like that big jump after the H1 results?
Exactly. August 21st, they release results, strong revenue headline, reduced net loss headline, and boom, the stock surges over 100% pre-market.
Shows how sensitive it is to perceived good news.
And how focused the market, or at least parts of it, can be on just those surface metrics, ignoring the underlying distress, reacting to headlines, not the fundamentals.
What about short interest? Are people betting against it?
It's actually quite low, around 1.1% to 1.4%.
So not much bearish sentiment.
Not necessarily. It could just mean the stock's too illiquid, too small, too volatile to be an attractive short target. Risky to borrow and bet against.
Makes sense. What are the technical indicators saying? Price chart stuff.
Well, the current price, around 75 cents, is below its 50-day moving average. That's typically seen as bearish, short-term,
Yeah.
but it's significantly above its 200-day moving average, which could suggest a longer-term positive shift.
But you sound skeptical.
For microcaps like this, the 200-day is less reliable. Those big news-driven spikes can really distort the long-term average. It's not a clean signal.
Hashtag Chapter 5. Ownership structure. All right, Chapter 5. Ownership structure. Who actually owns EEIQ? This can tell us a lot.
It really can. Institutional ownership, the big funds, the professional money managers.
Almost zero. Exceptionally low. Less than 1% of the shares.
Wow, less than 1%.
Yeah. Big names like UBS, Citadel, they have tiny, almost negligible positions. And Citadel actually cut its small position by over 60% recently.
That's a decrease in conviction, even on a tiny stake.
To me, this lack of institutional sponsorship is one of the biggest red flags. It shouts that the professional investors, the ones doing deep dives, think the risk-reward just isn't there.
So who does own it then?
Insiders, management and founders, they hold an extremely high percentage,
How high?
around 51.71%.
Okay, over half the company. Now, high insider ownership can be good, aligning interests.
If they're buying more shares, showing faith.
Exactly. Do we know if they've been buying recently?
We don't have data on recent purchases. So this high ownership might just be a legacy thing from founding the company. Or maybe they just haven't had a good way to sell.
Right, not necessarily a vote of confidence in the current state.
So this means ownership is highly concentrated.
Extremely. You've got insiders with over 51%, retail investors with almost 48%. That leaves a tiny public float.
Meaning not many shares actually trade freely.
Right, which leads to low liquidity, wide gaps between buying and selling prices, the bid-ask spread, and makes the stock incredibly sensitive to what a small group of retail traders do.
Hence the extreme volatility we talked about.
Precisely. Sentiment swings among a small group can move the price dramatically.
Hashtag Chapter 6. Risk assessment. Okay, Chapter 6. Risk assessment. Got to understand the downsides. Let's do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats, strengths.
We touched on these. Niche market focus international students. Owned assets, Davis and EduGlobal. Established partnerships, like with Miami University.
Weaknesses. These seem pretty obvious by now.
Yeah, glaring. The severe liquidity crisis. $0.33 million cash. Current ratio 0.57. That's an existential threat. Chronic unprofitability. Microcap status, relying on dilutive funding.
Opportunities, despite the problems.
Well, the market is huge and growing that $433 billion potential. They could expand geographically. Africa, Latin America were mentioned. Maybe integrate AI down the line.
But the threats seem pretty immediate.
Very intense competition. The Nasdaq delisting clock is ticking September 2025. Regulatory changes, especially visas, and geopolitical tensions. Big ones.
Let's dig into macro factors. Inflation. How does it hit them?
It's a double whammy. For students' families overseas, local inflation eats into savings, makes tuition harder to afford.
Right. Less demand, potentially.
And for EIQ itself, inflation pushes up their costs, salaries, utilities, squeezing margins that are already negative.
What about interest rates?
Higher rates tend to strengthen the U.S. dollar, makes U.S. tuition more expensive for international students. Plus, it makes any potential debt financing more costly for EEIQ, if they could even get it. But the really sharp risk right now seems geopolitical. Specifically, U.S.-China relations.
Those new U.S. tariffs on Chinese goods in 2025.
Exactly. Research shows a clear link between trade policy and student flows. Remember the Trump-era tariffs? Chinese student numbers dropped significantly, cost universities over $1 billion.
And EIQ is heavily reliant on China.
Exceptionally exposed. In fiscal 2023, students from the PRC were 66.4% of their customer base. 2/3.
Wow. So these new tariffs could seriously damage their main recruitment pipeline.
It's a huge risk. You could say EIQ is caught in a geopolitical vice, deteriorating U.S.-China relations, squeezing them on one side.
While the UK and Canada might be tightening up, increasing competition on the other side.
Exactly. Trying to diversify away from China now is really a race against time for them.
Hashtag Chapter 7. Conclusion. Okay, Chapter 7. Conclusion. Let's pull it all together. Time for the final summary. What's the bull case, if there is one?
Well, it's a high-risk, high-reward turnaround story if you squint really hard.
Okay.
They are in a big, growing market. The H1 2025 results did show that strong revenue growth, 29%, and the dramatically reduced net loss, down 95.5%, That hints at maybe some operational fixes.
And their diversification plans make strategic sense.
And the price-to-sales ratio is low, 1.06x. And it's a massive, if they somehow navigate this cash crisis, maybe there's upside.
Okay, that's the bull case. Now the bear case, which feels substantial.
Overwhelming, really. It's
Yeah.
grounded in that precarious financial reality. They are, quite simply, on the brink of insolvency.
The $0.33 million cash, the 0.57 current ratio, the constant cash burn.
Yeah. Any operational improvements are totally overshadowed by the deteriorating balance sheet and the fact they're selling assets to survive.
Plus, no institutional investors. A huge red flag.
And that imminent, very real threat of Nasdaq delisting. The most likely outcome seems to be, well, bankruptcy, or maybe more highly dilutive financing that just crushes existing shareholders.
So, valuation summary.
Given the negative cash flow, any number is speculative. But our optimistic DCF, remember, that yielded $0.20 to $0.45 per share.
And the stock is currently trading around 55 cents.
Right. So as of August 23, 2025, the current share price of $0.55 looks fairly valued to maybe even overvalued compared to even our optimistic intrinsic value guess.
Meaning the market isn't pricing in enough risk.
Exactly. The exceptionally high risks here are just not compensated by a sufficient margin of safety at this price.
So this deep dive into EpicQuest. Wow. A company in a booming market, headlines look better, but underneath, a profound cash crisis.
It's a stark reminder, isn't it? Not all revenue is equal. Turning sales into actual sustainable cash flow, that's what really matters.
Absolutely. It really makes you think, when you see that top-line growth number, you have to
Oh, yeah.
ask, where's the cash? Is the balance sheet healthy? What are those hidden signals?
Yeah. What signals do you look for to spot the difference between promising growth and, well, a house of cards? Something to chew on.
Okay, that wraps up another deep dive. If you found this analysis insightful, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
And remember, for just $499 a month, members get priority deep dives on tickers. We're tackling all the S&P 500 stocks over the next few months. Members get exclusive priority access.
Or if you want a one-off deep dive on a specific stock that's caught your eye, just drop us a super thanks. We appreciate the support. And the usual disclaimer. Please remember, this deep dive analysis was generated by an AI system. It's for educational purposes only.
It is definitely not financial advice. We strongly encourage you to do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Absolutely. Do your own homework. Thanks for joining us on the deep dive.